And then currencies are simply systems of money. And they are specifically, in this particular case that you're looking at, this is simply a standardized agreement. It's the Federal Reserve note, so it's an agreement that this is worth $1. And the party receiving it agrees, okay, I'll accept this with that unit of account as being worth $1. So what did the Bitcoin white paper actually solve? And again, you will find hundreds of articles that will claim that the Bitcoin white paper solved the Byzantines' general problem. That is incorrect in its generality. It solved a particular version of the Byzantines' general problem. And to outline this really quickly, it's a compute problem in distributed systems where you cannot rely necessarily on all those parts being either honest or, in the case of computers, being functional at any given point in time. That's why in compute it's typically called Byzantine's fault tolerance, as in if one component fails to perform its function, then the other components that comprise the system still need to be able to jump in and complete the same function. So these following ones are the actual innovations, inventions that the Bitcoin white paper introduced. And really you can reconcile this to simply the last one, which is the topic of quote unquote smart contracts. The better term is probably self-executing code, because these contracts are not very smart. They're mostly if-then statements. If I feed a certain input into that particular machine, then I get a certain output. But based on that particular invention, meaning solving the double spend problem using a combination of proof of work and Bitcoin and blockchain technology, we'll get to that part. It solved the Byzantine generals problem in the context of participants that are unknown. And with that, it introduced the first quote unquote, and I'm going to stop using that, just assume that a lot of the terms that I'm using that people have been using as metaphors in the space are in air quotes. And there it introduced the first digital asset in form of the Bitcoin mining reward. It's always important to understand that unfortunately the naming convention is a little funky in Bitcoin, because the name of the blockchain is Bitcoin, and usually a good way to discern that is to use the uppercase B for the blockchain, the lowercase b for the mining reward. But there is actually no minting function if you use that particular metaphor, and I'll speak to that maybe some more later. But then the second most, and maybe actually ultimately the most important invention that Bitcoin introduced, was the principle of decentralized autonomous organization, the DAO. So Bitcoin is the first example of exactly that. So now I'm going to move on and speak specifically to things that people have been conflating on a consistent basis, and just point out that these are not blockchains. So a lot of times you'll hear people use the term blockchain technology. So as I mentioned before, the Bitcoin white paper did not invent blockchain technology. Actually, it doesn't mention the term itself. There's a reference in the second footnote that references a particular paper that was issued about a decade before the Bitcoin white paper was published, and it refers to a particular encryption using blocks, a time-stamping mechanism. And so that part of blockchain is blockchain technology, but blockchain technology and blockchains are not the same. You will hear a lot of people talk about investments in blockchain technology. And so what they're saying, essentially, they are investing in a particular form of encryption. But the confusion here is the same as if you were to use some internet protocol, let's say the voice over IP protocol, to build an application, or SMTP protocol to build a mail messenger. So obviously you didn't invent the internet, you're just using internet technology to power an application. And so there's a very important difference to understand. And oftentimes what we see that people that are using the term blockchain technology either haven't understood the paradigm and or implemented the paradigm in kind of the wrong fashion. I'm going to talk to this some more. Then another explanation for blockchains that I still hear on a weekly basis, at least, I just heard it yet again by Jason Calacanis, so should really know better, is that blockchains are like databases. They're not like databases. They're very much the opposite. And so the main misunderstanding here is that the objective of a blockchain is not to store information, but it stores the state of the chain. So it stores the state of the participating computers. It's not about storing transactions necessarily. Actually, this kind of idea of having a public ledger is something that a lot of second layer applications, and in some cases, first layer applications, are trying to solve, because actually a public ledger obviously opens up an attack vector. And ultimately, and that's probably the simplest way to understand a blockchain, blockchains are the solution to what is the problem of databases, the control over bytes. And I'll break this down in larger strokes here in the future. Another conflation, and there I was very disappointed, was just reading Giancarlo's book, who I respect very much, but he keeps conflating DLTs and blockchains, so distributed ledger technology and blockchains. And as I just mentioned, it's not about the ledger. The ledger is a problem more than it is a solution, and should be the exception to the rule that there's a readable ledger for anything, because it's really about the control over bytes. So DLTs are not blockchains. DLTs are more like shared databases than they are like blockchains. And then the next thing that we're going to talk about is emails that we get on a daily basis that promote the idea there's crypto adoption, blockchain adoption, cryptocurrency adoption, NFT adoption. And the one issue that we have with that specifically as investors is this is